Imagine you are standing on the deck of a massive, unsinkable luxury ocean liner. But suddenly you feel the floorboards violently shatter beneath your feet. What if the very institutions designed to keep your money safe are actually the rogue waves about to tear your portfolio apart? Hello, this is WarmInsight. Today we're going to talk about the hidden, systemic risks and political volatility, completely reshaping the United States investment landscape. Leaving a like and subscribing is a huge help to us. Let us dive deep into the numbers and the history that the mainstream media is completely ignoring right now. We are currently witnessing an era where escalating political violence, weaponized legal processes, and rapid technological disruption are fundamentally breaking the old rules of investing. The perceived erosion of institutional norms and increased partisan polarization are introducing unprecedented systemic risks to market stability. But what exactly does the erosion of institutional norms actually mean? Think of an institutional norm, like the unwritten rules of a playground basketball game. There are no referees on the playground, but everyone generally agrees not to punch each other, not to cheat on the score, and to play fair. Because if people start throwing punches, the game is ruined for everyone. Institutional norms are the unwritten rules that keep a country functioning. When politicians start breaking these rules to destroy their opponents, the entire financial playground collapses. Investors must now recalibrate their portfolios for a new era, defined by elevated domestic political volatility and the very real potential for massive regulatory overreach. To understand this, we have to look at the institutional market dashboard and specifically a metric known as the VIX index. Right now, the VIX is sitting at 18.5 and trending upward. The VIX is often called the fear gauge of the stock market. It is like a giant smoke detector for the economy. When the VIX is low, it means investors are relaxed. The skies are clear and everyone feels safe. When the VIX spikes, it means the smoke detector is screaming and investors are rushing to buy insurance for their portfolios because they smell a fire. An upward trending VIX reflects rising investor anxiety. Amid escalating political tensions and election uncertainty, historically massive spikes in the VIX have preceded devastating market crashes. Look back at the 2008 financial crisis. Before the banks collapsed, the fear gauge started twitching, warning the smart money that the foundation was rotting. Look at the 2020 global pandemic crash. The VIX exploded to catastrophic levels as the world locked down. Today, the VIX is creeping up not because of a housing bubble or a virus, but because of pure political instability. While the fear gauge ticks higher, the S&P 500 index is moving sideways. Despite individual stock movements, broad market sentiment is extremely cautious. Investors are holding their breath, waiting for clarity on political stability and regulatory shifts. It is like driving a car into a thick wall of fog. You take your foot off the gas pedal, because you do not know if there is a clear road or a cliff ahead of you. At the same time, we are watching the price of West Texas. Intermediate crude oil climbed to $82 a barrel. This is not just numbers on a screen, this is geopolitics in action. Risks concerning the Strait of Hormuz are adding a massive premium to energy markets. Let us break down why this matters so much. The Strait of Hormuz is a narrow waterway between the Persian Gulf and the Gulf of Oman. It is the most important oil choke point in the entire world. Imagine a giant garden hose that waters the entire global economy, and the Strait of Hormuz is the narrowest part of that hose. If anyone steps on that hose, the global economy starts dying of thirst. The current administration's engagement with Iran regarding this strait highlights how United States domestic political considerations can directly influence global flashpoints. To understand the terror, this strikes into the hearts of institutional investors. We have to travel back in time to the 1973 oil crisis. During the Yom Kippur War, the United States supported Israel, and in retaliation, Arab oil-producing nations launched an embargo. They completely cut off the oil supply. The price of a barrel of oil quadrupled almost overnight. In America, this caused absolute chaos. Cars lined up for miles at gas stations. People fought in the streets for fuel, and the stock market was decimated. It triggered a devastating economic condition called stagflation. Stagflation is like having a terrible fever, while simultaneously freezing to death. Prices for everyday goods skyrocket, but the economy stops growing and people lose their jobs. Today, if political gamesmanship causes a disruption in the Strait of Hormuz, that hidden tax on the consumer, will instantly destroy the purchasing power of the middle class and send shockwaves through the global supply chain. This is why the defense sector is currently seeing a massive upward trend. Increased military spending and geopolitical friction are providing heavy tailwinds for defense contractors. When the world feels dangerous, nations buy shields and swords. We are seeing a deeply fractured domestic environment driving this danger. The United States' internal political volatility is increasingly reverberating across global markets, creating a complex web of uncertainty for international investors. The recent assassination attempt on President Donald Trump is a glaring, terrifying example of this instability. When political violence erupts, it shatters the illusion of civilized society. Let us look at the historical context of political violence and the markets. In 1912, former President Theodore Roosevelt was running for a third term when he was shot in the chest by an assassin while giving a speech. The bullet was slowed down by his thick speech, manuscript, and a steel eyeglasses case in his pocket. Roosevelt miraculously survived and actually finished, giving his speech with a bullet in his chest. In 1981, President Ronald Reagan was shot outside a hotel in Washington. The stock market immediately panicked. The New York Stock Exchange actually halted trading and closed early that day because absolute terror gripped the financial sector. When leaders are targeted, the foundational stability of the nation is thrown into question. Foreign investors look at the United States and wonder if the world's superpower is slowly degrading into a fractured state. This heightened perception of political violence, coupled with intensified political polarization, forces capital to flee from risk. But physical violence is not the only weapon tearing apart the institutional fabric. We must look at the weaponization of the legal system, highlighted by the highly publicized James Comey indictment. When the justice system is perceived as a tool for political revenge, we enter incredibly dangerous historical territory. The most chilling parallel to this is the fall of the Roman Republic. For centuries, Rome operated on a strict set of unwritten rules and legal traditions that prevented any one man from gaining too much power. But then, politicians like the Gracchi brothers started bypassing the traditional legal processes to pass their agendas. They were met with political violence. This escalated until a general named Sulla marched his own army into Rome, took over the city, and used the Roman legal system to write lists of his political enemies. If your name was on the list, you were executed and your wealth was confiscated. The law was no longer a shield for the innocent. It became a sword for the powerful. Once Rome crossed that line, the Republic died, and a dictatorship was born. Today, when retail and institutional investors see former directors of intelligence agencies facing highly publicized indictments and political figures threatening to jail their opponents, they see the ghost of the Roman Republic. Capital demands predictability. If a foreign billionaire wants to build a massive factory in Texas or Ohio, they need to know that the laws today will be the same laws 10 years from now. If the legal system becomes a weapon that changes based on which political party is in power, that billionaire will take their money and build their factory in a different country. This is how empires slowly bleed their wealth away. Adding fuel to this fire of polarization is the relentless media cycle, exemplified by the bizarre Jimmy Kimmel feud. You might wonder why a feud between a late-night television host and political figures matters to the global economy. It matters because it is a symptom of a deeply sick, hyper-polarized society. This emotionally charged environment is a perfect breeding ground for a psychological trap, called the availability heuristic. Let me explain the availability heuristic in simple terms. Your brain is essentially a prediction machine, but it is a very lazy prediction machine. It judges how likely something is to happen, based purely on how easy it is to remember examples of it happening. It is like being in a dark, scary forest, and you only have a flashlight that shines directly on a pack of angry wolves. Because all you can see are the wolves. You assume the entire forest is made of wolves, completely missing the safe, clear path right next to you. If you watch television news that constantly shows riots, political feuds, and screaming matches, your brain becomes convinced that the entire world is collapsing. The media amplifies these incidents to generate clicks and advertising revenue, but it injects a potent cocktail of fear directly into the retail investor psyche. This triggers herd mentality. Herd mentality is when people stop thinking for themselves and just copy what everyone else is doing out of panic. Think back to the most famous example of herd mentality in history, the tulip mania in the Netherlands in the 1630s. People literally traded their life savings, their houses and their land for a single tulip flower bulb simply because everyone else was doing it. And they thought the price would go up forever. When the bubble burst, thousands of people were financially ruined overnight. Today, the narrative of escalating political violence and toxic media feuds fuels widespread retail panic selling. Average everyday investors see the angry headlines, feel the panic, and dump their life savings out of the market at the exact wrong time. They make impulsive reactions and speculative bets based on political sentiment, rather than actual fundamental mathematical analysis of the companies they own. While retail investors are panicking over the Jimmy Kimmel feud and the daily political drama, the smart money is playing a completely different game. Institutional investors, the massive hedge funds, and the sovereign wealth funds are strategically positioning themselves to capitalize on mispriced assets. They are implementing sophisticated hedging strategies. They do not care about the noise, they care about the data. They are meticulously analyzing the long-term policy, implications of potential regulatory shifts. One massive shift on the horizon is the proposed artificial intelligence bill. The government is trying to regulate AI and stop the distribution of deep fakes. A deepfake is a highly realistic computer-generated video or audio recording that makes it look like someone is saying or doing something they never actually did. It is a terrifying weapon for political manipulation. But trying to regulate AI is like trying to catch the wind in a net. Let us compare this to the invention of the printing press by Johannes Gutenberg in the year 1440. Before the printing press, books were copied entirely by hand, by monks, which took months. Information was strictly controlled by kings and the church. When Gutenberg invented the printing press, suddenly, thousands of books could be printed in days. Information exploded. It caused massive political upheavals, scientific revolutions, and religious wars. The kings and queens were terrified. They tried to pass laws to ban printing presses, but they completely failed. You cannot put the genie back in the bottle. The current AI bill holds significant global implications. It sets a precedent that could influence the broader landscape of global technology regulation. It could lead to a fragmented international tech market, where AI is legal in one country but illegal in another. Institutional investors are trying to figure out which technology giants will survive this regulation, and which ones will be crushed by compliance costs. Similarly, savvy investors are aggressively scrutinizing sectors directly impacted by trade policy. Take the recent General Motors tariff refund. While it looks like a domestic victory for the automotive industry, it serves as a stark, terrifying reminder of the destructive power of global trade policy. A tariff is basically a massive tax placed on goods coming from another country. It is like building a giant moat around your lemonade stand to stop other kids from selling lemonade on your street. It sounds great for you at first, but then you realize you also locked out the delivery truck that brings you your lemons and sugar. Throughout history, tariffs have frequently caused absolute economic devastation. The most famous example is the Smoot-Hawley Tariff Act of 1930, after the stock market crash of 1929 panicked United States. Politicians wanted to protect American farmers and businesses from foreign competition. They passed massive crushing tariffs on thousands of imported goods, but they forgot about human nature. Other countries immediately retaliated by passing their own massive tariffs against American goods. It sparked a brutal global trade war. Global trade collapsed by over 60%. Thousands of businesses went bankrupt, and it turned a severe recession into the absolute nightmare of the Great Depression. Today, an administration prone to using tariffs as a political weapon can instantly trigger retaliatory measures, reroute vital global supply chains, and artificially spike commodity prices worldwide. These domestic United States political dynamics are amplifying broader global trends toward deglobalization and nationalistic economic policies. We are moving away from a connected global village and back toward fortress nations building walls around their economies. This forces multinational corporations to navigate an incredibly fragmented and less predictable global economic order. So, what is the Titans' playbook? How do the massive institutional players survive this chaos? They operate on what we call the generational bargain. The prevailing market sentiment right now is an uneasy, toxic blend. It leans heavily towards intense fear concerning systemic political risk. But it still exhibits pockets of extreme greed in specific, resilient growth sectors. The broad market is pricing in significant heavy uncertainty regarding policy, predictability, and potential social unrest. Yet, investors are simultaneously chasing returns in areas they believe are insulated from domestic political headwinds. This creates a dangerously bifurcated market. It is a split reality. Caution dominates the macro outlook, yet speculative appetite persists for high-conviction growth stories. This leads to elevated, violent volatility as sentiment swings dramatically with each new political headline or late-night legal development. To survive this, institutions use the asset allocation seesaw. The recommended defensive split right now is 50% stocks, 35% safe assets, and 15% cash. Given the heightened political volatility, capital deployment must prioritize pure resilience and defensive growth. What does defensive growth look like? Consider increasing exposure to utilities exchange-traded funds. A utility company provides electricity, water, and natural gas to homes and businesses. Why are they safe? Because they are essential. Even if a civil war breaks out, even if the stock market crashes by 50%, even if the president is indicted, people still need to turn on their lights, run their refrigerators, and drink clean water. Utilities provide stable dividends and are incredibly insulated from economic cycles or political whims. Additionally, healthcare exchange-traded funds offer brilliant defensive characteristics. Healthcare is built on non-discretionary demand. That means people do not choose to buy healthcare for fun, they buy it to survive. Sickness does not care about political polarization or trade tariffs. Continuous medical innovation provides a reliable, heavy hedge against broader market instability. For growth with a defensive shield, smart money targets technology exchange. Traded funds that focus strictly on established large-cap leaders. With fortress-like balance sheets and massive global revenue streams, they completely avoid highly speculative, unprofitable startup ventures. The massive tech leaders have innovation, pipelines that transcend domestic political noise and regulatory nightmares. But the ultimate survival mechanic, the VIP action plan, requires aggressive, calculated maneuvers when the system flashes red. If political rhetoric surrounding potential election challenges or institutional crises intensifies further, if you see the VIX, fear gauge spike by 20% over a single week, institutional giants will immediately increase their allocation. To gold exchange-traded funds, let us talk about gold. Gold is the ultimate historical anchor of human wealth. For over 5,000 years, spanning back to the ancient Egyptians, the Roman Empire, and the British Crown, gold has been the supreme safe haven. Why? Because you cannot print it, you cannot hack it, and it never rusts. After World War II, the global economy was stabilized by the Bretton Woods system, which tied the value of the United States dollar directly to physical gold. But in 1971, President Richard Nixon completely severed that tie. He took the world off the gold standard, allowing governments to print endless amounts of paper money out of thin air. Since then, whenever governments print too much money and cause inflation, or whenever political systems threaten to collapse into violence, smart capital instantly flees into gold. It acts as a traditional heavy shield against systemic uncertainty and currency devaluation fears. Another crucial maneuver is initiating a position in global infrastructure ETFs. If a bipartisan infrastructure spending bill miraculously gains unexpected traction post-election, it signals a return to collaborative policymaking. Rebuilding bridges, highways, and power grids provides a tangible, massive boost to actual economic activity, regardless of which political party holds the presidency. But the most important rule of the Titans playbook is what you absolutely must avoid. Do not ever succumb to emotional trading based on daily political headlines or toxic social media narratives. Panicking out of, diversified positions during periods of heightened political noise is a fatal error. Chasing speculative rallies fueled by unconfirmed political rumors on social media is a critical mistake that can permanently impair your capital and completely derail your long-term financial goals. Remember today's warm insight. In the midst of terrifying political storms, market history repeatedly mathematically shows that resilience and long-term value creation often emerge from periods of perceived absolute chaos. The market ruthlessly punishes the fearful and heavily rewards those who maintain rigid discipline and focus far beyond the immediate terrifying headlines. Throughout history, markets have navigated catastrophic world wars, bloody political revolutions, and severe burning social unrest. They almost always find a path to recovery and sustained, massive growth. The enduring, unstoppable capacity of human innovation and ingenuity to adapt has consistently proven far more powerful than transient, temporary political turmoil. This underscores the long-term, undeniable upward bias of well-managed economies. Stay focused, stay disciplined, and do not let the noise steal your future. We couldn't fit all the deep dive details and practical strategies into this video,